South Africa's current account deficit held steady in the third quarter. That's at 6.4% of GDP. This as lower than expected dividend payments to offshore investors countered a shortfall on the trade account. Other data items point to a tempering pace of domestic spending. This is what Deputy Chief Economist at the Reserve Bank, Johan van den Heever, had to say earlier today on the numbers.
If you produce less than what your expenditures are, then you do have a deficit and you do have to finance it somewhere. And that is our situation then. Fairly firm expenditure, but much of that is related to fixed capital formation, which has a high import content and which is actually quite desirable. So we should not be, I think, too unhappy about the strength of our import bill. It's a sign of future improvement in our infrastructure situation. As far as household consumption, however, is concerned, there was also quite firm progress still in durables and semi-durables consumption, and that also has, to some extent, an import component. However, the current account deficit was 6.4% of GDP. It was also 6.4% of GDP in the second quarter, so it's a sideways movement. Fortunately, as before, it was readily financed, and the money for that came from all three the types of capital flowing into the country, namely direct investment, portfolio investment and other investment. All three of those were positive overall, and the deficit was easily financed.
Joining us for more detail on that, Brigid Taylor, Head of Institutional Flow Sales at Nedbank Capital. Brigid, welcome. Those final comments from Johan, just that warning that we need to finance this deficit, 6.4% of GDP. It's better than the market had expected, but we remember the hoo-ha, the fuss last quarter when we had this huge surge in our shortfall.
Well, I think that what we're starting to see is that the extent of the extreme of it is what's concerning the market. And I mean, if you've seen what happened on the trade numbers, you are seeing a slowdown in growth. You will see further deterioration, no doubt, in the first, as we produce the numbers for this last quarter, because predominantly a lot of the impact that we've seen recently will only really be represented into that number that will only come through in February next year, which will represent fourth quarter. That's both from a GDP perspective as well as the current account. Because the trade continues to widen, as much as there is a little bit of a cushioning at this point, the reality is that there's going to be infrastructure spend, etc., so that we can expect the current accounts to remain under pressure.
The rand will be the balancing item there, responding to that shortfall.
Absolutely, and I think from that perspective, there's a couple of key risks that we need to watch out for going into 2013. Is global growth, as we've seen by the BOE statement, as we've seen with the ECB, significantly slower. And we obviously run the risk that the United States may not come online as robustly as people are hoping for. And where does that really then, where does the growth stem from? And especially in our environment where a lot of productivity has been lost, business is under pressure, investors are cautious, underlying fundamentals aren't looking as rosy as they were previously. And there is a large concern in terms of, are we going to continue to see the robust inflows that we saw this year on the back of the likes of the WGBI inclusion?
Mark, we've spoken about this so many times. You can see investors then really going for the emerging market, frontier market growth story, which they're getting through our retailers. Again, Mr. Price doing rather well today, against the story of South African exports not looking that appealing.
Yeah, I don't tend to fixate from a sort of accounting point of view on this short-term data. What does encourage me is that we are building capacity in the SA economy, and it's been long overdue. And there's a hell of a lot more to come, be it water or and so forth. But certainly we are seeing. I mean, I've tracked the currency against the real, and in fact we've shown some remarkable strength coming through there too. So there's certainly a more upbeat sentiment, and I'm seeing it from clients in the US who are still keen selectively on South African equity, and they're prepared to put their money where their mouth is.
And just be more specific, sorry, Brigid.
What's interesting from that perspective, though, is I think what you've seen and what we've certainly seen specifically this week is that there's been that renewed interest. Why? Because there's a complete deterioration in terms of any other form of valuable yield opportunities, whether they're equity-based, whether they're bond-based. And in fact, one of the statements and one of the questions that was asked to Mr. Draghi after the ECB statement was made was, were cuts considered? And in fact, he made it quite clear, he insinuated that they'd had a discussion around it, they'd made a decision on this outcome to choose not to cut rates. However, that still remains something that's on the table, and from that perspective, a global investor would be foolish not to continue to put their money where they still deem some form of some form of growth, or should I say some form of return. The problem is what people are starting to do is negate the fundamentals purely just to get the return. Why? Because they can get their money out as quickly as they got it in.
So on the fundamentals, the local stocks, some of them looking overvalued, and also our long bond, the inflow into our long bonds today, do you think that's contrary to fundamentals?
Well, what we've seen really in the bond market, I mean, the bond market, the curves flattened 14 basis points in the last 3 days. We've seen a rally on both the 213 and the 186 to the tune of almost 20 basis points. That's by and large been foreign investment, either coming directly in and buying the outright bond, or what we're seeing on our yield curve is, if you look at the belly of the curve, being the 203, 204, 207, 208 stock, almost 50% of those stocks are owned by foreigners. And what they're starting to do now is they're switching out of the belly stock that's become quite expensive into the longer dated, more valuable stock. And that switch out has then seen the curve flatten. How much absolute income is coming in, I think, is actually predominantly going to the equity market. So you're seeing the Rand rally, and it's performed really, really well because we saw the euro come off today and the Rand didn't react at all. It was purely just as an investment play.
Well, just taking that point, I mean, when Jill Marcus announced that she wouldn't cut rates, there was an expectation that there'd be a shift in that yield curve coming down, but in fact it went slightly up and the Rand stayed weaker. And it just seems that after the announcements today from the BOE and ECB, everyone said, well, what the heck? And the shift came. And I think we're going to continue seeing that because if we're not going to see good GDP growth next year, then rates are going to stay flat, if not a 25 pip cut.
You see the thing, and that's exactly, he's 100% right. And what you're also seeing is that foreign investors are also saying, we want to see South Africa, we think that South Africa has got room to cut rates. So at these levels, and especially in the longer duration play in the curve, there's value in their minds. So for them, getting rates
Brigid,
like
if there isn't a cut, is there still value there?
If there's no cuts, it just, all that happens is at some point that it gets valued out. So the equation becomes neutral, and then it gets to a point where there's just no more buying. The oversupply potentially could steepen up the curve again. However, it really does, the market is at this point being driven predominantly by the foreign play, and the foreign play is seeing this continuation of a deterioration in terms of the rates outlook. So that is driving investors into a better yield or a better opportunity.
Mark, you referred earlier to the capacity building that we're seeing reflected in our import bill. But if you look, for instance, at the gross fixed capital formation released in these quarterly bulletin numbers today, a lot of the growth is coming from the public sector rather than the private sector. Correct. So still not enough confidence there amongst private sector players.
And there's a lot of cash on books. So they're sitting on cash. We were discussing it earlier and saying the cash positions in the private sector is hugely long. Why? Because they don't really know that they want to invest into an environment where there's zero growth, where there's a lot of political uncertainty, and certainly where they're not sure that the productivity is going to be equivalent to the investment that they've made.